Hello and welcome, dear investor. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. In this video, I show you how you create from scratch a solid dividend portfolio. Solid in a way that if your neighbor is a professional portfolio manager, for example, and he sees your portfolio, he'll ask you about who was your consultant, and maybe he will think to employ him or even get his consulting services too. And it's really not that difficult. I'm always a little bit, sometimes I'm a little bit embarrassed because it's so easy, but it all depends on the right tool. Always consider that on the one hand, Dividend Stocks Cash is very powerful and also easy to use. On the other hand, it's a screener only, so you will always have to do some due diligence. Apart from using a single tool like this on Dividend Stocks Cash. So let's go. I know many investors scanning half of the internet on social media and on different financial services and so on to get an idea which stock to buy, which stock is promising and so on, and they often change their mind depending on who said what or who wrote what. This is not the right approach. I will show you one approach right now. And here we are on the screener. And the first thing to do is to find, or the first thing to do to profit from growing dividends and capital gains as well, they go hand in hand, is to find companies which increase their earnings, their profits, steadily, reliably on the long run. How do you do that? It's very easy. You have a ranking column here, and you just need to create a ranking which reflects the stable long-term profit growth. There's already a ranking here which is close to this. You see these green fields here, and they are all profit-related fields. We say this field considers stable earnings growth, the reported earnings this way, and one is the extreme, so there's not a single stock matching this one, I guess. But anyway, we make this very demanding, and then at the end there won't be probably there won't be a 100 ranking, which means all criteria are fully matched, but there will still be high rankings, and the stocks which rank very high are the stocks the most promising. Then we see here the operating cash flow. There we do the same, and they always come in pair, these fields. You always need to find stocks with reliable, steady profit growth on the one hand. So think about a ruler. It's just one single line. This represents the one, and then we need the angle to determine the angle, the growth angle of this ruler. And this is the growth rate, always related to the last 5 years. And that's basically the same, just related to operating cash flows. And that's again once more the same, just related to sales or total revenues. And then we can apply this, and now you will see that the ranking is going to change. And now all we need to do is to filter by the ranking column in descending order, so that the best stocks which fulfill our criteria set defined here the most. You see there's not a 100% or not a 100 ranking, but already some stocks which come in very close, and these are all promising stocks. And now we make a visual check right now to get a feeling about the quality of the stocks. You see here that most of the stocks come from the United States, but number one is a stock from Great Britain. The stocks you find here are international, so they are mostly from the Western Hemisphere, but there are also some Asian or Australian stocks included. If you look at Rightmove, for example, I don't know if you know this stock. It's an internet company where you can find a house to buy or to sell, depending on what you want. And now you see here both cash flows, free cash flow, operating cash flow, your earnings and dividends. And you see that these earnings are increasing very reliably with a nice angle. And you see that it's the same for the free cash flow and for the operating cash flow. They are all extremely similar, so they are not very high investments, it seems, if you look at the free cash flow. And you also see that the sales, the revenues, they increase very steadily. That's really nice, and that's exactly here what we defined in the first row here. And you can also take a look at the rankings, how each criteria was matched. So it's as said, the one here in the stability matrix or stability criteria is not completely matched, 98% always, 99% in this case, but that's already very good. Yeah, Alphabet, you probably know, American Tower, Tower Read, and so on. You know these. And if you just select all these stocks, Alphabet now, and then you'll look at the earnings and at the operating cash flows, and you see that they increase very smoothly, reliably. The matrix are always calculated till last 12 trading months, which means in this case that the Corona crisis, which causes deterioration of many figures, isn't considered yet. You might think that's there's a trade-off. We could have implemented it, but the problem is that estimates are not reliable, contrary to the past. That's why we only considered the past. It's up to you to consider the future, which can easily be done because we have the estimates here. We also have the outlook or matrix based on the estimates. You see it here, here, and here. The compound annual growth rate based on the estimates. Okay, what you do now is just you basically create a watch list and add the promising stocks here. Before doing so, maybe if you are from the United States, and then chances might be that you're not interested in stocks outside the United States, company outside the United States, then you apply the filter here. For example, you filter for countries exclusively from the United States. You see here which countries we have. We also have Russia, for example, Singapore, South Korea, and so on. And it's always the original stock which is analyzed here. So it means the currency here changed depending on the country of the company. It might be South Korean won or Japanese yen or whatever country. Euro is also very often. Then you just click here on the watch list to add the stock. You see that the first stock disappeared. Rightmove disappeared because it was a stock from Great Britain, and then you just select the stocks. But I told you, I nearly forgot that we created dividend portfolio, and I just selected the company with Alphabet not paying dividends at all. So Alphabet might not be that interesting for you, which means we have to adjust our ranking, and now we need to consider these blue criteria also, because they reflect dividends. Let's say we need or we want dividend yield of 2% at least to get 100 points, and then dividend increase of 10% per year, and also extremely stable dividend payments based on the dividend history. We apply the ranking, and now you will see that there will be a difference in the ranking criteria here. For example, Alphabet. What happens with Alphabet? It gets a 0 ranking because Alphabet is not a dividend stock, which means that for you as a dividend investor, this company is not interesting at all. But there are still stocks with left with very high rankings, and we can just sort once more and once more to get it in descending order. Here it is. And now we have here Comcast, Texas Roadhouse, for example, CME Group, Extra Space Storage, and these might be interesting stocks. You see this awards column. This means that the companies shine either by earnings or by earnings or by dividend growth metrics. You can always look at the detail here using the tooltip. So Comcast, for example, if we select the stock, you should also see very nice increases here in cash flows and earnings, at least since 2004. We have metrics for a very long time, starting from 1990 in this case, and now since 2004, very nice earnings. You also see here that the company increases revenues since that's 1990, so since 30 years already. And the margins are rather stable, at least since 2000, 2004, 2005. Okay, then you could just add these stocks to your portfolio. I'm doing it a little bit fast. Of course, you should make your analysis a little bit more deeply. For example, Texas Roadhouse. It's a cyclical stock, cyclical company. And the cyclical nowadays means that there might be a problem, especially for restaurants. It's a restaurant, you can see it here, which means that most of the restaurants, especially in the United States, for example, will be closed, which means revenue will go down. And I think that the estimates start to reflect this, because here we see a decrease in revenue, not in revenue yet, but in the earnings and cash flows already. So it starts to go down. And yeah, of course, you need to consider the special situation we are in. But I'm just telling you how normally, in general, you you make stock picking of first-class stocks, and these are first-class stocks. Look at Paycheck. Just look at this single chart and you see that the stocks are first class. Just look at this chart showing you the margins and the revenue, and you see on company level, and you see that this is a verification that we have a first-class company, and you can just jump on from one stock to the next, and you always find first-class company which made their investors happy in the long run, and chances are that this will be still the case in the future. Here we have American Tower. It's REIT. For this we show funds from operations additionally. And the nice thing here is that we get the valuation of any stock, and once for dividend investors interesting, let's start with the valuation maybe. Here we have the valuation of American Tower. You can just blend in the earnings, cash flows, funds from operations, and based on this you can make a valuation. For example, we need to find the representative period of this stock. Current price earnings is about 26 based on funds from operations. So maybe let's select this one. Yeah, don't pay dividends for a very long time already. It's because if you want the fair value based on dividends, but then we need to select a shorter period. But dividends are still very low, below 2% or about 2%. That doesn't matter. So wait, because no one is probably buying the stock because he wants high dividends. If you look at valuation, you see here let's zoom out. You see here the black line. That's the stock price, the historic stock price, the current stock price, $217 US, and then we see these different fair values, which are all calculated On parallel, you see that the stock price respects the calculated fair values. Let's get rid of these fair value based on dividends, because I just told you that it's not that interesting. It's one of the rare stocks where rare REITs where dividends might not be that interesting. American Tower, you see that the stock price nicely reflects both, in this case, operating cash flows and funds from operations. You see that the stock is ambitiously valued here. It had a nice run, and although the stock price diminished a little bit in the current crisis, it dropped till 118, now it's 217. It's still a little bit overvalued, and which means that you might not expect capital gains in the medium term over the next years. But it's a world-class stock anyway, and you can see here. You can also see, let's look for a more interesting dividend stock, for example, T. Rowe Price Group, because they have a dividend yield more than 3%. And now I show you another thing, which is a dividend turbo. Now there are some special dividends. That's not that nice. Dividend stocks cash also shows you separately these special dividends. Let's have a look at Paycheck. I hope they don't pay special dividends as well. They also paid special dividends here, but it's still good enough for us. So here you see the historical dividend yield up to from the year 2000, and you see that Paycheck at the beginning of this millennium paid a very modest dividend yield. Then they got an increase, probably because they aggressively, because they increased aggressively their dividends or dividend yield. Dividends were $0.50 in 2005 and $1.20, more than doubled in 2008. Dividend yield increased, and now we have dividends $2.50 about, and a yield of 4%, which is, as you can see here, much more than in the years following the financial crisis. But in the financial crisis, which started here, we got up to 4.6%, and this is an outlier due to special dividends here. You can also see that special dividends were paid here in this chart. So I showed you how you find promising, or not only promising, high-class companies, high-class dividend-paying companies here, just by creating your own ranking. There are already default rankings for dividend investors. There are dividend growth and dividend income rankings. They are already there as a default, just to give you an idea how to use it. And if you, I think, I don't tell you to do so, but I think if you just blindly select the first 10 or 15 stocks, you already just completely blindly, you have a better portfolio than most other dividend investors with nearly zero time. Just try it and make some more due diligence, and then you might you can verify if the stocks really met your criteria or not. Of course, you'll have to consider to get a nice diversified portfolio. You have to consider the sector, industry, and so on. Maybe you are a little more demanding about the country diversification, not to buy only stocks from the United States, but you can easily do so by removing this filter here. No, here's the country, sorry, by removing this filter here or turning off the filter completely, and then you get back all these stocks here. Okay, so it's my point of view really easy to use, and just try it out. If you have any questions, ask me and I will gladly answer. Thanks for watching and see you next time. Bye bye.